You know that awkward moment when you realize someone, somewhere, has been quietly getting richer, while you're still arguing with your bank app about why your balance looks like a bad joke? Well, there's a reason for that. A rule. A very old one that Chinese have used for generations to build wealth, while the rest of us are busy chasing financial hacks that expire faster than a supermarket discount. And no, this isn't mystical, exotic, or sprinkled with the usual influence or nonsense. It's a rule that shapes how families plan, how businesses grow, and how ordinary people accumulate money with a patience that would make the average Westerner break out in hives. In this video, you're going to understand exactly how that rule works, why it outperforms most modern advice, and how you can use it without moving to Beijing, learning calligraphy, or pretending you suddenly love green tea. By the end, you'll know the mindset that quietly compounds wealth behind the scenes, the reason many people fail even when they're doing everything right, and the simple actions that can help you stop playing financial whack-a-mole and start building something that actually lasts. If you've ever felt stuck, inconsistent, or like money slips through your fingers the moment you touch it, this is the moment you stop blaming luck and start learning the rule that's been working for centuries. You know the funny thing about wealth? Most people treat it like a lottery ticket, but the families who actually get rich treat it more like a relay race. And this is where the Chinese rule starts showing its claws. It isn't flashy, it isn't loud, and it definitely doesn't care about your "I deserve it because I had a hard week" purchases. It's built on a simple idea. Every financial decision should make the next decision easier, not harder. Sounds boring, right? Until you realize this is exactly why some families keep rising while others keep restarting from zero every decade. Take a typical example. In many Chinese households, when someone earns more, the default reaction isn't, "Finally, I can upgrade my phone." It's, "Good, what can this unlock long-term?" Education funds, business capital, assets that create more assets. The reward isn't immediate comfort, it's strategic leverage. Meanwhile, plenty of us celebrate small income increases with restaurants, gadgets, and a burst of confidence that lasts about 3 days. And here's where you come in. Think about your last 3 financial moves. Did any of them make your future easier, or did they just make your present slightly shinier? If this hits a nerve, drop a comment telling me the last time you bought something you instantly regretted. Trust me, you're not alone, and your honesty will probably help someone else watching this. This rule works across generations because it refuses to let short-term instincts sabotage long-term strength. It builds stability layer by layer, almost invisibly, until one day you look up and realize there's a structure, not a collection of random purchases. And if that feels painfully different from how you've been doing things, good. That means we're getting somewhere. Here's where the rule stops being philosophy and starts messing with your daily life. Because it's easy to talk about long-term thinking when you're calm, hydrated, and not being hunted by the latest limited edition anything. But this rule, it sneaks into the small moments, the ones where most people accidentally set fire to their wealth-building potential. Picture this. 2 people get the same raise. One thinks, "Fantastic, now I can finally afford that subscription I'm not even sure I want." The other, following this rule, asks, "How do I turn this raise into something that pays me back later?" Same situation, opposite trajectories. One grows expenses, the other grows capacity, and the gap between them starts quietly, then becomes embarrassingly obvious. In many Chinese households, every daily purchase gets judged by a ruthless question. Does this strengthen the family or weaken it? Not emotionally, not theoretically, economically. Buying a tool that helps the family business? Strength. Paying interest on a random impulse? Weakness. Saving for a kid's education? Strength. Financing a shiny new distraction? Well, you know the answer. The uncomfortable truth is that most people leak money through tiny, unexamined habits. The rule closes those leaks by forcing intention into every decision. Not obsession, intention. Because you don't need to track every coffee as if your entire net worth depends on it. You just need to recognize when you're spending out of boredom, habit, or ego instead of strategy. A quick reality check. Look at your last week of spending. How many purchases made your future self proud? And how many made your bank account cry quietly in the corner? If this stings a bit, tell me in the comments which habit you think drains you the most. Others will recognize themselves, and you'll probably feel less like you're the only one sabotaging yourself on autopilot. The beauty of this rule is that it doesn't demand perfection, it just demands alignment. Once your daily decisions lean towards building instead of weakening, the compounding does the heavy lifting. You just have to stop fighting against your own future. Here's where things get a little uncomfortable. The part most people skip because it forces them to admit they've been playing the money game on easy mode while thinking it was expert level. The big mindset gap isn't intelligence, culture, or luck. It's expectation. Many Westerners expect wealth to feel good right now. The rule expects wealth to feel good later and demands that you deal with the slight annoyance of discipline today. Think of it like this. A lot of people treat money like a pet they hope will magically grow into a lion. Feed it randomly, forget about it, panic when it misbehaves, and then wonder why it never becomes powerful. Under this rule, money isn't a pet, it's a worker, and workers need direction, structure, and consequences. No one's coddling it, no one's letting it express itself. Every euro has a job, and if it's not doing that job, it's reassigned without mercy. This shift explains why many Western savers feel stuck. They're technically saving, but mentally, they're still expecting the process to be fun. Spoiler, it isn't. Not at first. It's like going to the gym. No one leaves the first session feeling like a Greek statue. You leave sweaty, confused, and slightly betrayed. But give it time, and the strength shows up, quietly, predictably, inevitably. Want an example? Look at spending on status. The average person buys visible upgrades to feel successful. The rule says invest in invisible upgrades that create success. One gives you compliments, the other gives you options. Guess which one actually moves the needle? And let's be honest, you've probably felt this tension. The moment you try to be smarter with money, someone around you inevitably says, "Live a little," which translated usually means, "Spend like me so I don't feel guilty." If you've been there, drop a comment about the last time someone tried to pressure you into spending on something you didn't even want. It's almost a shared human experience at this point. Here's the punchline. The mindset shift isn't about being frugal, strict, or joyless. It's about replacing emotional decisions with strategic ones. Once you stop letting your moods manage your money, everything becomes easier. Not immediately, but steadily. And steady beats explosive in the wealth-building game every single time. Here's where the excuses usually show up. Sure, this rule worked 100 years ago, but today life is expensive, unpredictable, chaotic. Yes, and water is wet. Modern life is messy, but that's exactly why this rule hits harder now than ever. Because when everything around you pulls toward impulsive spending and instant gratification, choosing structure becomes a competitive advantage, not a sacrifice. Let's land this in reality. You don't need a multi-generational family business or a hidden empire of rental properties to apply the rule. You just need a system where your money flows towards strength instead of noise. Start with the obvious. Automate the boring parts. Saving shouldn't rely on whether you're in the mood to be responsible that month. Move a percentage of your income the same day it arrives. Treat it like a mandatory invoice from your future self. If that hurts a little, congratulations. That's the sign you're doing it right. Then, upgrade your spending categories. And no, I don't mean add more of them like some productivity guru trying to sell you a pastel-colored spreadsheet template. I mean, simplify. 3 categories: necessities, investments, and noise. If you're brave, track your last month and see how much went into that third bucket. That number alone will explain why your money isn't doing overtime for you. Now the part where the rule becomes ridiculously powerful. Turn every extra euro into a multiplier. Got a bonus? Side income? A tax refund that feels like winning a very boring lottery? Good. Don't kill it immediately with expenses disguised as treats. Use it to reduce debt, increase cash flow, or buy assets that generate money while you sleep, shower, or pretend to be productive. Look at someone who applies the rule today. They're not necessarily rich yet, but they move differently. They don't panic at the end of the month. They don't chase trends. They stack advantages, one decision at a time. And while everyone else keeps resetting their finances like a broken video game, they slowly build momentum that compounds quietly in the background. If you're thinking, yeah, I really should fix my money system, tell me in the comments which part you struggle with most: saving, investing, or controlling impulse spending. Your answer might be the wake-up call someone else needs.